You know, one of the even more sort of staggering statistics when you look at the 125 million households in the United States is that about 32% of them fall between the ages of 55 and 70. And even more astounding is that it's only 32% of the households, but actually 57% of overall household net worth. So not only is the number of people retiring going to be extremely high over the next set of many years, but also the amount of wealth that's going into retirement is also going to be peaking in the next several years. I put up this slide that you see in front of you here, which I think is just a really great summary of just how challenging your jobs are in generating income in the current environment. So what you're looking at here is essentially yields on various different assets, whether it be cash, 10-year treasuries, munis, investment-grade credit, on all the way to equities and dividend-paying stocks on the far right-hand side of the page. And it goes back as far as we can possibly find data. So you'll notice for U.S. 10-year treasuries, as an example, apparently in the late 1700s, Alexander Hamilton and his successors were recording monthly treasury yields, so we actually have that data. And so the green bars here are showing you the range from low to high, sort of for the entire time series for the yields on those assets. The white triangle is showing you the overall average, and the blue triangle is showing you effectively where we are today as of the end of 2016. And the thing that's going to pop out from this chart the most is the fact that those blue triangles are well below, in most cases, the white triangles. Most assets are either in or at or near all-time lows for the furthest history that we have. So really, again, just characterizes how difficult it is to generate yield in client portfolios. If we fast forward and take sort of the most simplistic view of constructing a portfolio to generate income, it's the 60-40 portfolio that we've all heard about and lived with for many, many decades now. So what you're looking at here is taking some of that data from the last page, putting a bond component in the portfolio of 10-year treasuries, pairing that together with just an investment in the S&P 500, and it's looking at the overall yield that 60-40 portfolio generates over time, well over a century. The light blue portion here is showing you the equity contribution to that overall yield. The dark blue is showing you the bond contribution to that overall yield, and that black line is the total yield for the portfolio. Key takeaway from this slide, overall historical average over that almost century and a half is 4.3%. You know, that's a pretty reasonable amount to expect to be able to withdraw from a portfolio over time to fund a retirement, that sort of 4% level that we've heard about for quite some time. But when you look at the end of December and really over the last decade plus, or really 2 decades, you find is that today, the yield coming off of that portfolio has effectively been cut in half. And so you can manage around that in some ways by adding high yield debt here or emerging sovereigns there, or however you want to do it. But at the end of the day, what you're doing is increasing risk for client portfolios. That can certainly be a challenging proposition. And it turns out, though, that clients, because of the experience that they've had over the last really decade or so, a little over a decade, that's not really what they're interested in doing, is increasing the risk in their portfolio. You've got a group of people that, if you think about sort of their investment horizons over the last 30 years, they've lived through some pretty robust bull and bear markets, some of the most robust over time. But also, smack dab in the middle of those have been 2 majorly severe bear markets of 40% downsides, which hadn't really happened since the Great Depression. So naturally then, their frame of reference is risk-focused. So Mackenzie did a study back in 2015, and they determined that there were 4 sort of key client objectives that came out of their study. Protecting principal, hedging against downside risk, minimizing volatility, which of course are all around this idea of risk reduction. The 4th consideration was, of course, generating income for all the reasons that Ari and I mentioned before about the number of baby boomers retiring and that need for income that exists. And so this preservation of lifestyle is incredibly, incredibly important. And no surprise, investors have spoken with their feet. So what you're looking at here are assets in some popular ETF products, really because it's a great proxy for overall investor sentiment. So looking back over the last decade plus, you're looking at ETFs for dividend yield, low volatility, the multi-factor, some of the smart beta products. And by far and away, the most popular ETFs in terms of flows and overall assets have been dividend focused, outside of course, market cap weighted ETFs, which are another whole story. But so dividend paying ETFs have been extremely popular. Of course, the second most popular has been the low volatility ETF. You really see that start to tick up post-credit crisis. And interestingly, which we'll talk about in just a moment as one of our first considerations for equity income, is the fact that dividend paying stocks did really, really poorly between 2012 and 2015. And yet at the same time, clients were willing to sort of sacrifice that poor performance in order to gain overall yield in the portfolio. And so when we sort of zoom in on that period of the last several years, what you're looking at here are portfolios for the strongest dividend paying stocks, both in the US by itself and then also on a global basis. Because as we'll show in a few slides, there are a lot of dividend payers that exist outside the United States that are certainly worth consideration. But this just gives you a sense of the fact that between that period of 2012 and 2015, even if you were just a U.S. dividend-focused investor, times were really, really tough. You're going to notice that those light blue bars there, so that's showing you the outperformance and underperformance for that set of strong yielding global dividend-paying stocks, is much, much worse than those on the U.S. front. There are a couple reasons for that. First of all, we are in a really interesting period, or were during this time, where the S&P 500 U.S. domestic stocks really just absolutely knocked it out of the park. So over this period from 2012 to 2015, the S&P 500 returned a cumulative 77%. So massively strong returns for the market overall. But when you compare that to developed international markets, and leaving out the United States, obviously, it returned just 34%. So a massive 40% gap between the U.S. and its developed international counterparts. And then emerging markets did substantially worse. They actually had a negative return overall of negative 3%. So if you're looking at any portfolio that includes something outside of the United States, that's going to be a pretty massive headwind, which of course global dividend payers do in fact have allocations outside of the United States.
For anyone that has questions as we go through the course of the webinar, there is an arrow in the upper right-hand portion of your screen, an orange arrow. If you have questions, just hit that arrow, and you can send your questions to us online. We'll address questions at the end of the presentation.
And so when you kind of drill down into some of these years also, it's a really kind of interesting story and this chain of events that have occurred that have also sort of conspired to make dividend yield underperform, which obviously when you're talking to clients about diversifying their sources of income, whether it be into just equity markets in general, U.S. dividend paying stocks, global dividend paying stocks, the first thing that they're going to look at is the trailing performance. And that's not exactly the most rosy picture. And so it's, obviously important to consider sort of the forward-looking aspect of it as opposed to just the rearview mirror. So the kind of the three main events that caused this to occur for dividend yields was, number one, we talked about, which was the massive outperformance of the S&P 500. And in the context of that bull market, when you've got a group of stocks that tend to be more conservative in nature, in some ways lower in terms of volatility, more conservative, they're going to lag the overall market as a whole. The other thing that we saw is that in 2014, we obviously had the energy fiasco where you saw oil get cut in half. Another aspect of that a lot of people may not necessarily think to immediately when you hear about oil that kind of overshadowed what was going on is just the massive appreciation that occurred in the U.S. dollar in 2014. The U.S. dollar between July of 2014 and March of 2015 appreciated 23%. And so to just put some context around how massive a move that was, if you look at all of the 9-month rolling periods back on the dollar index, back to 1967, of which there are well over 500, it ranks number 3 as the third most significant move. So you had a massive move there, and obviously anytime you see appreciation of the dollar, that's going to be a headwind for any investments, again, that are focused outside of the United States. And then we rolled forward a little bit to 2015. And for those of you that think back to 2015, the Fed started to be having some rumblings about increasing interest rates. And all of a sudden, the focus of investors turned towards the FANG stocks, Facebook, Amazon, Netflix, and Google, which of course are a number of companies that aren't particularly interested in paying dividends. So you had a confluence of events during this period, the outperformance of the S&P 500, a massive bull market, energy, the dollar, and the emphasis on mega cap growth stocks that really acted as this major headwind for dividend paying stocks, which, those are obviously all pretty logical things that occur. And we hope that doesn't stray investors away from dividends, which we believe is a very effective way to generate income in retirement and for total return overall. I talked about the fact that the global opportunity set for dividends is quite immense. When you think about sort of the tried and true U.S. dividend paying strategy, you classically think of those U.S. dividend payers, the ones that have been paying dividends for over 100 years and have been consistently growing them over time. They tend to be U.S. domiciled. When you look at the entire global universe of dividend paying stocks, the U.S. actually only represents about 1/3 of dividend payers. There are lots of companies that are out there that are higher quality in nature, in a lot of cases tend to be discounted in terms of valuation, that are certainly worthy of taking a look in overall portfolios. And so to sort of, complete sort of this first consideration of equity income, which is that dividends have struggled over the recent past, it's important to realize and take sort of a step back at the broader perspective of dividend paying stocks. So what you're looking at here is strong dividend yielding stocks looking all the way back to 1970, and you're looking at rolling 3-year excess returns. So if it's above the dotted line, dividends are outperforming. If they're below the line, dividends are underperforming. And what you see is pretty similar to what you would see if you looked at a value and growth chart or a small and large cap chart, where just as value and growth or small and large cap stocks tend to change leadership over time, the exact same thing happens with dividend yield as an investment factor. They come in and out of favor. And so, I'll just point out as an example, on the right-hand side of the page, obviously we're below the dotted line there, so dividends have really struggled, as we've seen. But if you shift over just a little bit to the left, what you'll see is that massive spike. That was the recovery after the tech bubble, where obviously nobody wanted anything to do with value or dividend-oriented stocks in the late 1990s. They significantly underperformed, and then we saw this massive snapback over time. So this cycle repeats itself, and the overall underperformance of dividend yield is really not unprecedented overall. And so with that in mind, we've talked a little bit about the past. Let's talk about the future. The thing that's top of mind now, whenever you bring up a dividend-oriented strategy, is really rising interest rates and the Fed raising interest rates moving forward. I alluded that to a little bit earlier. So what we've done is we've got lots of data here. I already talked about the fact that we're factor investors and we're quantitative in nature. We've got lots of data on individual stocks going back to the 1970s globally and back to the 1920s in the US. And so what we did was we identified 12 rising rate environments going back to 1970. And the way that we defined a rising rate environment is to say, define environments where the U.S. 10-year Treasury rose by 1% or more over a 12-month period. And then we looked at the performance of groups of stocks during those periods. And so this chart that's in front of you is showing an average over those 12 rising rate environments back to the 1970s and through today, the excess performance of various different sectors. Because the adage always goes that when you have rising rate environments, that you don't want to be in utilities, you don't want to be in consumer staples, you don't want to be in certain areas of the market, and dividend stocks in particular tend to underperform. Well, that's partially true. It's not totally true. What we find when we look at these groups of stocks in the market overall is that on average it is true. Utilities do tend to struggle in rising rate environments overall. That'll become very important in a moment as we sort of broaden this out to the idea of constructing a portfolio. Financials actually struggle also. Included in the financial group are a name that have become much more popular over the last 5 to 10 years, which are REITs. REITs do tend to struggle a bit in rising rate environments. The challenge with that, though, is that there's really not a lot of robust REIT data except for the past 3 rate rising cycles. So it's certainly not a conclusive case at this point yet. We'll have to see how they play out over the next several. An interesting one within financials also, though, is that actually banks sometimes don't always do particularly well. We saw last year that financials really ran up very significantly, particularly in the fourth quarter, as we saw the talk of rising rates tick up a notch. And what we found is that within the financial space, within banks specifically, what you tend to find is that they do very, very well. The returns of their stocks do exceptionally well in advance of the rate rise, not necessarily during the rate rise itself. So a lot of it's particularly front-loaded. When you get in the actual rate rising environment itself, you actually want to favor sectors like energy and technology. There's some logic behind this. With infotech, you tend to have companies that tend to be less levered overall, so less need for financing activities, which naturally flows through to earnings and differentiation from the market. And then you've also got the energy sector, which energy is much more highly tied to commodities and oil, the dollar, things of that nature, as opposed to specifically rates itself. And it actually, technology and energy together tend to be 2 of the least correlated with the other sectors that exist also. So long story short, it's very important to understand what's in the portfolio in these rate rising environments, as opposed to just a wholesale saying, let's not be focused on dividend paying stocks specifically. On this slide page here, we've done, there are tons of numbers on this page. I promise I'm just going to point out the really important ones. So this is breaking down those 12 individual rate rising cycles, but we wanted to show you what it looks like when you just take out, for example, the worst performing sector that we just looked at on the last page, which was utilities. And so if you look at that green box, what you're looking at here, that number 13.4, that is the overall average return for the S&P 500 in these 12 rate rising environments. And so, what I take away from that is when rates are rising, it's typically for good reason. There are inflationary pressures, economic growth tends to be mild to okay, and equity returns actually do pretty well. The overall average for the past several decades is around 10%, so 13.4% is a pretty robust return overall. Shift over one number to the right, that's 6.3%. That is an investment in the strongest dividend yielding stocks in the US during that period. 6.3 is a lot less than 13.4, so that sort of handles our question there about whether or not US dividend payers do well in those rising rate environments. They struggle. But if you take utilities out of the equation when you're seeking that dividend portfolio, that return increases to 11.1%. So still lagging the market, but a pretty robust return overall, and particularly if you're looking for someone, or if you're constructing a portfolio for someone that needs to generate income, not too bad. Shift over to the next group of numbers, which is doing that same analysis, but expanding the opportunity set outside of the US to global. The overall global benchmark, the MSCI ACWI, does 14.3% on average in those 12 rate rising environments. Global dividend yield, again, including all sectors, does 11.4%, underperforms. But take utilities out of the equation, on average, your return actually then outperforms the overall market. We've always taken the perspective in managing dividend portfolios that global diversification is a great thing alongside of U.S. dividend portfolios. You get diversification across different currencies, interest rate environments, different economies, different inflationary regimes, which we believe tends to be on a risk-adjusted basis better over time. And I think that this really, really speaks to that. So next consideration for putting together equity income portfolios really dovetails on this idea of you really need to know what's in the portfolio. We talked a little bit about utilities, but what I want to talk about now are dividend ETFs. Certainly no question that I'm sure that a number of you use these ETFs in your portfolios, or you're probably also competing with investors that are using these as well, or retail investors that are using these as well. So what's so important when you look at the most popular dividend ETFs, I'll call them mass market exposure to dividend yield, is that you really need to get under the hood and understand where the exposures are. Because when you really do, the exposures across different ETFs in the dividend space, they really aren't all that different. And this graphic is showing you that. So what we've done here, each of the large bubbles gives you the ticker of one of the four most popular dividend ETFs. And you'll see the spokes coming off of those ETFs, and they go to these bubbles. And each of the bubbles is giving you an individual ticker. Those are the underlying holdings of these four ETFs. And what you find is that the spokes start to connect in the middle of the graphic overall. That's showing you the overlap of individual holdings within each of these four portfolios. And what you also see is that these bubbles in the middle, that's the size of the bubble is related to the allocation of that name within these portfolios. So the larger the bubble of the individual stock ticker, the larger the allocation across the four ETFs. And you find that the largest ones are in the middle. So long way of saying that when you look at the underlying holdings of these four very popular ETFs, there's really only 20% of the underlying holdings that are unique across the ETFs, meaning they're not held in common with more than one of these large ETFs. Now, there's a pretty logical reason for this. If you're a fund sponsor and you're the sponsor for VYM or DVY or SDY or VIG, these ETFs all have, let's say on average, assets of around $17 billion. So they're very large strategies, right? There are only so many dividend-paying stocks to go around, and they're all playing in the same space. So the overlap very naturally is going to be quite large. There's kind of another phenomenon at play also that I think that a lot of people do not realize, which is that when you have an ETF that is that large and you want to have allocations to dividends in the portfolio, in order to build that massive scale of $17+ billion on average, you've got to have some sort of a tilt towards market capitalization. Otherwise, you're not able to make large enough allocations to individual names in the portfolio. And I'll just give an example of that. So Xerox today is offering a 4% yield overall. It's about an $8 billion stock. So if these ETFs want to have, say, a 1% allocation to that overall, they've got to build an $800 million position, which is a massive holding in an individual name. So there's tons of overlap in these underlying ETFs overall, and you need to be cognizant of that. And because of all of the flows into these ETFs, which has been about $100 billion since 2009, it has pretty significantly pushed up valuations on dividend-paying stocks as a whole. And it's been pretty much aligned with market cap. So I'll give you an example of that. When you look at the underlying holdings of these ETFs, and you look at all the names that have a weight of 1% or greater versus those that are weighted at less than 1%, what you find is that the lowest weighted names in the ETFs are actually the cheapest. So they're somewhere between 17 and 37% cheaper, whether you're looking at sales, earnings, cash flows. And oddly enough, the lowest weighted names actually tend to have the highest yields. The yields on average are 10% higher than the highest weighted names in the ETFs. So again, if you're truly focused on generating yield in portfolios, these mass market ETFs may not necessarily be the best way to do that. And so, naturally, another way to think about dividend yield, which is actually one that we appreciate in a number of managers that we fit in well with in portfolios with, use the idea of dividend growth. Dividend growth has sort of always been around as this sort of tried and true idea of investing in the company that's been growing dividends for 10, 20, 30 years overall. And that seems to be a very logical way to invest. But when you actually dig down and look at that strategy and look at the evidence, it actually doesn't pan out quite like that. So what you're looking at on this chart is looking back to 1975. We're looking at dividend growers overall over a couple different time frames. So stocks that have low and high dividend growth based on 1 year, 3 year, 5 year, and 10-year dividend growth, and the outperformance and underperformance relative to the market overall. And the results are actually a little bit opposite of what you would expect. So I'll just use as an example 5-year dividend growth and 10-year dividend growth, where it's actually the lowest dividend growth overall that tends to be the one that outperforms the most. Where, as an example, when you look at 10-year dividend growth, the ones that grow the most actually underperform the market by 0.7% on an annualized basis over this full time period as well. So the implication of this, should you stray away from dividend growth? Not necessarily. Sort of the key component of all this that ties it all together is that dividend growth on its own is not an effective strategy, but when you pair it together with something like quality or valuation, that's actually how most dividend growth managers go about actually building their portfolios overall. Which speaks to the next point, which is this idea of how important things like valuation are overall. So on this slide, what you're looking at is we've taken a couple of different regions around the world, looking at PE ratios, looking at the overall global benchmark, and looking at the PE ratio recently of those most popular ETFs on the far left-hand side of the screen in a portfolio that we manage called Enhanced Dividend, which invests in dividend-paying stocks on a global basis, of course tying in valuation and quality, some of the things that I mentioned. But what's truly interesting about this and amazing about this is just how expensive those popular dividend ETFs have become, trading at valuations of almost 24 times earnings, which is a premium to the overall S&P 500, premium to the global benchmark, and a premium to the portfolio that we manage of nearly 40%. And I would say that if there is one thing that we've learned through all of our research and believe as gospel, as do many successful investors, is that ultimately investments are all about the price that you pay for the investment. So whether you believe that an investment in dividends, dividend yield, or dividend growth is a great thing, there has to be a tie to valuation that is so incredibly important. And what you're seeing today in some of these mass market ETFs really goes against that trend overall. And this slide speaks really to the proof in the pudding, so to speak, where we took high dividend yielding stocks, so strong dividend yielding stocks, but then we broke them down further and said, all right, so within high dividend yielding stocks, let's group them by valuation. So expensive valuation, sort of in the middle, and then discounted valuation. So the three bars on this page share one thing, which is dividend yield. They're separated by another thing, which is valuation. And you find that even if you're invested in strong dividend yielding stocks, if you're in an expensive set of dividend payers, you lag the market by 2.4%, and you lag cheap dividend strong yielding stocks by 5.4%. So a pretty massive spread overall that exists, which is something that is incredibly important to pay attention to as you're putting together client portfolios. So sort of bringing all this home, we talked about 5 things. Hope you got some good snippets of information out of it. So number one, first consideration for equity income. Dividends have struggled over the last several years, but as you're looking at those performance reports and for dividends in general, do not count them out because it's going to be an important source of income for clients moving forward and really over the next several decades. Number two, there are certain dividend payers that struggle in rising rate environments, particularly utilities and some aspects of the financial sector. Make sure you know and understand what's in the portfolio and try to stray away from those and maybe angle a little bit more towards infotech and energy as examples. Number three, dividend ETFs are really not very diversified from each other, as investors are led to believe. And ultimately, you need to seek differentiated portfolios overall in building client portfolios. Consideration number four, dividend growth on its own is not the most effective strategy. You absolutely must pair it with things like valuation and quality overall. And then, of course, I just touched on it, but the fifth consideration, and probably the most important, is that valuation trumps dividends. It is the most important overall, and you need to pair dividend strategies with those valuation criteria.
With that, we're going to open up for questions. Again, to ask a question, there is an orange arrow on the upper right-hand portion of your screen. Simply click that arrow and a field will pop up for you to be able to ask your question. So, Ehren, the first question that we've gotten is you talked about the difference of globally oriented companies versus U.S. domiciled companies and the propensity to pay a dividend, and that a higher percentage of foreign companies pay dividends than in the U.S. Can you talk a little bit about why you think that is the case?
Yeah, so I think one of the things that we've seen in the U.S. is certainly more of a propensity to repurchase shares as opposed to pay dividends. There's a couple of reasons for that. Back in the 1980s, there was SEC safe harbor ruling, which effectively before that, corporate managers could be sued for market manipulation for repurchasing shares. After that SEC ruling, they could repurchase shares with abandon, and we've seen that become massively popular. It's certainly an aspect of the market that we've done tons of research about, and we love buybacks as a factor overall. But in the foreign markets, certainly dividends still remain to be the preferred way of rewarding shareholders. And ultimately, that's how we think about it, is a return of capital to shareholders.
Next question is the info on dividend yield versus dividend growth, and the performance of dividend growth as a factor is interesting. Any thoughts as to why that is the case over time, that yield seems to outperform growth?
Yeah, it's a good question. So we've done a lot of research around both aspects of it, and ultimately have favored dividend yield because dividend yield tends to have more of a tie to valuation, whereas you can have stocks that are phenomenal dividend growers, but they may not be priced appropriately. And so for that reason, we've always favored dividend yield.
The next question is actually along the lines of how you assess valuation. You mentioned the importance of identifying cheap dividend stocks versus expensive dividend stocks. Can you talk about the metrics that you found are the most effective for assessing valuation and making that distinction?
Sure. So valuation is always an interesting one. There's so much research that's out there on it, whether you're sort of the classic value metric of price to book or whatever it may be. We've done research on all of the underlying individual factors, PE, price to book, price to sales, cash flow, free cash flow, whatever they may be. And ultimately, we put together what we refer to as a composite or a theme for valuation. So we take a multi-factor approach. And the logic behind it is you really want a company that is inexpensive all the way from its top line of sales down through its bottom line of earnings and then through the cash flows that it produces. So we think very specifically about price to sales, EBITDA to enterprise value, which is sort of like operating cash flow, an operating cash flow metric. We look at price to earnings. We look at free cash flow relative to enterprise value. And then we actually also look at the buyback component that I mentioned earlier as well, within a metric that we refer to as shareholder yield, which combines dividends and buybacks. In U.S. portfolios, we would consider that shareholder yield component as more important. So when we think about specifically U.S. portfolios, we think much more about this concept of shareholder yield. But as it relates to the global portfolio, we use that as a component of the valuation metric.
Again, for those on the line with a question, the way to get your question to us would be to hit the orange arrow in the upper right-hand portion of your screen and just shoot it off to us. There are particular tax considerations for global dividends, for those dividends, domiciled outside the U.S. Can you just talk a little bit about what those are and what people should be on the lookout when investing in foreign dividend-paying stocks with regard to taxes?
Yeah, foreign taxes are certainly always an interesting one, so when we invest in global dividend-paying stocks, we tend to do it through ADRs, where the foreign taxes are withheld basically the way that it tends to work is your dividend will get paid into your client's account, and then you'll almost see an immediate entry where the foreign taxes will come out. And since it's tax time, I can definitely see why that's top of mind. So typically, your accountants, they'll effectively be able to file to get a tax credit for that foreign tax paid. And I would say, just kind of as a guideline, I know we've looked at it in our portfolio in the past. It tends to be somewhere around 8 to 10% of the overall yield. So if the portfolio had a yield of 4% overall, it might be somewhere between 30 and 40 basis points in terms of foreign taxes that are withheld. Of course, you get to use that as a credit come year-end tax time, so you don't necessarily lose that income.
One consideration in the dividend space is we hear about this concept of reaching for yield, or stocks that have high dividends for a reason. How do you guard against that, kind of the concept of the falling knives? How can a dividend investor, guard against that and that concept of reaching for yield?
So that's a good question, and it's very similar to how we think about the idea of valuation, and that I talked about. We actually also think about quality. I mentioned it one or two times in the presentation, but I'll talk a little bit about it now. So we think about valuation from a couple different angles. So number one, we want to make sure that the balance sheet of a company is strong. So looking at what we refer to as its financial strength, make sure that ultimately the balance sheet is financed organically by the company itself through its own operations, as opposed to being overly reliant on the secondary markets, whether that be through debt or equity issuance. That's going to become much more important over the next several years as interest rates starts to rise. I think that most people are underestimating the impact that rising rates are going to have on things like financing costs. The other perspective that we take is looking at the overall quality of earnings. Again, it's all about cash, right? You want to make sure that cash flows are really strong. And so we look to avoid companies that are basing their earnings on accruals as opposed to actually generating cash in the portfolios. And then there's another way to look at it also, which is more of a market recognition factor, which is looking at momentum. A lot of people use momentum in the positive screening sense of seeking stocks with strong momentum. That's not always the best combination in a dividend portfolio. But what is particularly effective as it relates to momentum is screening out stocks that have very poor momentum in the portfolio. And between the three of those, it helps you avoid a lot of the falling knives overall.
The next question that we've gotten is, since REITs are now their own sector and are no longer part of financials, are you still concerned for financials in a rising rate environment?
So I think that less so than has been the case in the past, because REITs do tend to be a lot more interest rate sensitive. I mentioned it briefly earlier, though. The challenge with sort of making a blanket statements about REITs and rising rate environments is that they've really only lived through a couple of them over the last several decades, because it just hasn't been as popular a place in the market. So my guess is that the decision probably shouldn't be made necessarily on a blanket basis that they're just you don't want to be in REITs because rates are rising. We'll have to see how that plays out. It's just not quite conclusive enough.